an engineer turned mutual fund manager.
When we always talk about long term is always broken into short terms also. There are people who are purist on one side, there are people who are purist on extremely other side, we are somewhere in between, which is blend.
They say that investing is also a self-discovery process. How did you evolve as a fund manager?
Aviation, hospitals, hotels, these are the businesses I never owned in my entire portfolio journey from 2010 to 20. But after 20, we have owned all three.
How did this difference in style happen?
It's more about the management quality and business quality rather than the valuations.
Hello all, welcome to Know Your Fund Manager series. I'm Satya Sundanam from Zerodha Varsity. I hope you are enjoying this series as much as I do researching and talking to fund managers. In this episode, we have with us Shridatta Bhandwaldar, the head of Equities from Canara Robeco Mutual Fund. An engineer turned mutual fund manager, Bhandwaldar has always been interested in understanding the market. He first made his debut in stock markets in 2006 and eventually joined Canara Robeco in 2016. He manages directly 4 funds: Canara Robeco Blue Chip Fund, a multi-cap fund, a flexi-cap fund, and a focused fund. Ask him about Canara Robeco's style of investing. He says it's a blend of growth and value style of investing. Let's pick his brain to understand this style of investing better. Thank you, Shri. Thank you so much for joining us today.
Thank you. Thank you for having us.
Yeah. I think this is the most frequently asked question to you. You've transitioned from being an engineer to a fund manager. So tell us, what are the qualities of an engineer that helped you become a better investor and the qualities that didn't?
Because clearly, I think if you step back and think about it, when you actually think about engineering, it's a course which, in my view, while I didn't like it as much as a lot of my peers liked it at that point in time, it clearly helps you in terms of developing your analytical skill sets and enhancing them more and more. It's a course where if you understand the concepts properly, you don't need to mug a lot of stuff. By mugging, you can't pass the exam. Okay, so those are the skill sets clearly. The analytical skill sets which as an investor it helps you to actually enhance your outcomes over a period of time, because when you think about investments, it's both understanding the bigger picture, understanding the opportunities, understanding the scalability of the business, but at the same time trying to backtest it in terms of, does that business or does that management have the ability to deliver it, have they delivered it in the past, and analyzing a lot of stuff. That's where I think the analytical skill sets clearly help. So that's one thing that has clearly helped. As you ask, what doesn't help? I can't think of anything that doesn't help. But sometimes you can get into too much of details. That's one thing I can say that could become that can be a shortcoming sometimes.
In this Know Your Fund Manager series, Shri, our aim is for the retail investors to know their fund manager better. It is often said that conviction cannot be borrowed, but I think we truly believe that, especially with retail investors investing in mutual funds, they have to have some, if not borrowing a conviction of a fund manager, they have to at least have trust on the fund manager so that they can stay long enough in the funds they have invested in and make better returns. Coming to your style of investing, as per my research, there are 4 broad points that you look at. The first is the quality of the business, and when you talk about quality, you look at the past performance and also the future earnings potential of the company. The second is you always talk about how the capital efficiency in the company is improving. The third is, of course, the management and the promoters, which you don't want to take it as a second priority. The fourth is, of course, the valuation. I want to go talk about each of these points specifically, but before going there, how did you narrow down to these 4 points?
There are, of course, multiple ways to, it's like saying there are multiple ways to go to nirvana, and you choose your one. But there are multiple ways to create wealth over a period of time. But one of the relatively more consistent or more effective way that I came across, and it of course happened after some amount of experience initially and a lot of reading, is that if you focus on businesses where the business quality, which means the characteristics of the business or business segments itself are inherently at advantageous position, which means little more structural. Every business is cyclical, but within that there are advantages. It's a business where generally there is a higher probability. See, how do you create a larger wealth or a more wealth over a period of time? By increasing the probability of the factors that you're playing. So one of the factor first, like what I'm saying, is how do you play that the quality of business itself is playing for you rather than against you. So that's one. Then you come to, okay, ultimately any business can create value only if it is beating the cost of capital, which is like I have a choice as an investor in a very, very simplified form to put my money in bank equity or a GSEC or a AA paper. In a very, very simplified form, your weighted average cost of capital that is considered, that if I am investing in business and taking that risk, say let us take my word for this, in India it is like 11%. For example, if my business is not generating ROE, ROC is upwards of 11-12%, then I'm not creating any value. Okay. So inherently the businesses have to be capital efficient, which means the cost of capital they have to cover through the returns, IRRs that they make in the business. So that's second factor which becomes great. If you are not doing that, which means you are actually destroying wealth, which means every second, third, fourth year, you will either need more of debt or you'll need more of a dilution, which means somebody else has to pump in money in the business. So that's second. Third is ultimately any basically business is as good as the person who's driving it. Okay. And which is management. And in management, it is about both. It is about the intent and it is about the ability. Of course, when you actually get into a good business, the ability, even if it is a little low, it might not impact you significantly, but still you need ability of the management, which means how is he executing vis-a-vis his peers in the same industry, whether they are getting market share or not, how their distribution strategies, how the product strategies, how their related or unrelated inorganic or organic expansions have been. But at the same time, more critical, particularly from emerging markets, if you look at it, they are predominantly, like for example in India, the businesses are predominantly owned by promoters. They have 50, 60, 70% of ownership, which means they are in a driving seat. Do they have intent to share the bounty that is going to come in particular business, assuming that this is a good business, with you as a minority shareholder or not? That's very, very critical. Because ultimately the business might make a lot of money, but it might not actually flow through to you as a minority shareholder through, whether it is directly through dividend, buybacks, or it is indirectly through incremental capital allocation in a good manner and capital efficient manner. Whichever way it is, his both execution and more importantly the intent of actually sharing or not sharing with you becomes very critical for wealth creation with you. So that's where the third factor come in. And last is valuation, which is I think far more contextual, far more sector dependent, far more what horizon a particular investor has. Because the intrinsic value of business is rarely gets captured in the typical parameters that people use in market, which is PE, EV by beta. Yes, it's a good ballpark indication of on a near-term earnings how the businesses are faring, but the longevity and scalability and the changing capital efficiency of the businesses can never get captured in the near term price to earning ratio or price to book ratio or EV by beta, and that's where understanding the intrinsic value of the business also becomes very, very critical.
I want to talk about the valuation a bit later. Talking about the earnings potential, because you look at the quality of the business and its earnings potential in the future. Now, if you go by the book of Joel Greenblatt, he wrote this book on the little book that still beats the market. He says when you're looking at the earnings, there are three things that are very important, which is the first, what are the near-term earnings look like? How confident are you that that estimate is correct? And how is it going to be after that? Is it something, the similar approach that you follow when you look at the future potential of the earnings?
Exactly. I mean, this is what you look at, because both your probability or your conviction on the near-term earnings, which means next 2 years earnings, and what is driving it. But at the same time, more importantly, stock price is not a function of next 2 years cash flows or earnings. Stock price is a function of actually discounted cash flows effectively over 10, 20, 30 years, depending on the longevity and scalability of the business. And that's where what is likely to happen in business after 1-2 years becomes equally or more critical in most of the time. So it's not that you're looking at necessarily the numbers themselves. You're just trying to understand whether the potential that you're putting up over a period of time, has it started playing out in terms of the underlying drivers or operating matrices in the business itself. Earnings is just one outcome of it. When we always talk about long term is always broken into short terms also. So you have to keep, there has to be some monitoring mechanism.
So you invest in new age companies where they say that in the initial few years there's not going to be any profit, and then after few years it can generate profits. I mean, let's take an example of Amazon. I mean, if a company like that is a few years back, the way it was, if such an opportunity comes to you, as per the Canara Robeco's style of investing, would you invest in that company?
So we do invest in new age companies as well, but within that, there's one thing that we take care of. As I said, the long term is broken into short term. So business might have started with making huge losses. You don't have to participate in it. Once a company is listed in market, and you're a public money manager, or even if you're a private investor, you don't necessarily have to participate just because in 10 year, 20 year, there is a huge potential. As I said in the previous question also, you're monitoring it every quarter, correct? You're seeing how the operating matrices are moving. You can always try to actually participate in that business when the outcomes are nearer in terms of profitability rather than longer. Which also tells you that the numbers is just an outcome. It also tells you that the business model is falling in place. The economics of the business is falling in place. The prices may not be, but that is basically always a balance that you have to find between the outcome that you desire and the realistic outcome that you can get without taking much of a risk. We would generally try to go into second, because in public listed companies, there's always an opportunity to keep tracking them every quarter and see whether those operating matrices are playing out or not, whether the economic model of the business is actually playing out or not. For example, without taking name, you just looked at last 1 year where there are two basically businesses where the economic model finally seems to be in place, correct? So there was enough time to participate in one of those, that name we also participated in a way. So if the profit pool is scalable over a period of time, we would want to participate in it, but we wouldn't necessarily participate in it till the time we get that initial assessment on the operating parameters or economic model of the business that, it is falling in place now.
Until you see the visibility of the earnings.
You see the visibility of more than earnings, the profitability of the business model and sustainability of the business model itself.
Now we talked about the first three things, which is the quality and whether the incremental capital efficiency is good or not, and the management and the promoters. And if all these things are good, then it is very difficult to see a company with a low PE or a low valuation. But you are saying that you are okay to pay a higher price, or I don't say compromise, maybe a trade-off, when it comes to valuation, and give importance to the first three parameters. Is that right?
So it's partly right, partly wrong, because it's not that you don't get some of these businesses cheap. You do get a lot of these businesses time to time on relatively not cheap basis, but you get at a reasonable valuation. Some of these businesses will never become cheap, okay? But there is also businesses which transition. like what I just told you, in hotels or hospitals. So there are a lot of businesses which are good on these parameters, but they are yet not identified in a fully manner. Or there is no full appreciation that, okay, these businesses have transitioned on capital efficiency. So when this happen, initially you get a lot of these businesses at a very, very relatively reasonable valuation, and then of course they re-rate. As market realizes it, it re-rates. But that proportion, as you rightly said, is smaller. And it needs a lot of work to actually find these businesses, because fortunately, unfortunately, Indian market is extremely competitive in capital markets in terms of the amount of research that happens, whether it is institutional investor, whether it is the non-institutional investors, whether it is family offices, PMSs, AIFs. So it's a very vibrant and basically a diligent marketplace out there. So those opportunities are relatively less. But if you just look at last 10 years, 12 years, you had chemicals, okay, which made this transition, and most of these businesses were available at 15p in 2014, 15, 16. Okay, you look at cable companies, you look at some of the capital goods companies, you look at the hotels, you look at the hospitals. My hunch is aviation is gradually going through that phase currently as we speak. This is not a recommendation to buy or sell, but this is just assessment that we have. The telecom has transitioned in terms of not necessarily the quality of management or business, but from a competitive perspective. So there are a lot of businesses which make these transitions time to time. Yes, but in proportion for us, they will still remain 30, 35, 40% at max. I'm just giving you a random or approximate number. Predominant part of the portion of the portfolio will be where you have to rely on compounding, that those businesses are identified, well identified at a portfolio level in terms of the quality of management and quality of businesses, quality of balance sheets. But there is a scalability, there is a capital efficiency, and managements will keep doing right things as a combination. So it will keep delivering 15% earnings, say 13 to 15% earnings growth, and it will keep delivering that 13 to 15% outcomes for you over a period of time.
They say that investing is also a self-discovery process. How did you evolve as a fund manager, and how could you now conclude that this is your style of?
Oh, it's very simple. You make a lot of mistakes. Every year you make mistakes and you learn. So initial period of your career, you made a lot of mistakes. You flirted effectively with every style, every business, deep cyclicals, narrow cyclicals, businesses where promoters are not necessarily have their fairness in place or integrity in place. So you did a lot of those mistakes, and then you realize, okay, this is what you're capable of. We're not saying by any means there are not multiple ways to make money. There are multiple ways to make money. It is what as a thought process you are comfortable with, what works for you. That's where you should rather spend your energy, because your right to win resides in that area, rather than actually delving into a lot of business where the complexity for your thought process is far higher.
In a couple of forums, you said that you understood the style of investing or the art of investing by reading Charlie Munger, Warren Buffett and Seth Klarman. They are like purist value investors. I wonder, how did this difference in style happen to you by reading their investing lessons?
So the largest impression from a lot of these guys probably is more about the management quality and business quality rather than the valuations. Actually playing relatively, not that we are averse to playing relatively cheap stocks, but predominantly playing more on the earnings momentum side, playing predominantly more in terms of scalability side, predominantly playing more on and willing to pay higher. That's where it has come up. It is also a stage of economy where we are. We think there are a lot of sectors where the growth is inherently available.
Okay.
And if growth is inherently available, why do you want to deal with relatively challenged businesses where they are mature businesses, or they are deep cyclicals, they are global cyclicals, there is an intervention from regulators, or there is an intervention from other stakeholders in those businesses?
Understood. Yeah. Does joining Canara Robeco has actually changed your style of investing? Earlier you were with SBI Pension and you were also a portfolio manager. does joining Canara Robeco has changed your style of investing, or you molded the style here, or you got molded by the style of Canara Robeco?
There hasn't been a significant change in the style. Yes, you learn from your colleagues, you learn from your bosses, you learn from the investment process that house has. So there is a incremental things that I have picked up even when I joined this firm. But I think the style has been predominantly similar.
Got it. If I have to give, we have to give a name to the style of investing that you're following. Maybe you can say blended.
It's a blend.
Understood. So almost all funds in from the house follow the same strategy.
It will be similar strategy. It is not the same strategy. For example, we also have a value fund. It is of course very, very different than the rest of the fund because it has a stated strategy of investing in value. Of course, for us, we run it a little differently. We run it on intrinsic value rather than just saying, okay, just put a statistics, everything below 15 PE is good and that should go in fund. We don't do that. But of course, it has a relatively more tilt towards a lot of businesses which are cyclical, deep cyclical, turnaround, because that's the stated strategy of the fund. But we still try to find out whether there is an intrinsic value in the business or not. And when we say intrinsic value, is it just that there is a value and it will never be delivered, or there is a value and we can put it on paper that, okay, or next 1-2 year, there is a tangible, discernible and time-bound driver in place, which I can put on paper and say, okay, अगर ये 2-3 चीजें हो गई, तो outcomes will come. Because you need drivers also to say that, okay, value is likely to get identified. Otherwise, that value will remain always value. So that's what we do in that fund. So that will be a little different.
So, out of all the equity funds that are there, you are managing, directly or as a co-fund manager, as a primary co-fund manager, you're directly managing the blue chip fund, flexi cap, focus. But there are other funds, multi-cap, yeah. And there are other funds also like emerging, equity. Can you talk about other fund managers and how your style of investing as a CIO reflects in their style of investing?
So, of course, as a house, we have an investment process. So every time we have a hire, we have a new fund manager joining in. Of course, you try to at least to see to it that it is not at a 180-degree tangent. Okay, it's not in the opposite direction. So there are a broader construct, and within that, when the new people join in, they start operating within the investment process. It's not a rigid investment process, but it only actually broadly talks about these broader parameters that, okay, you take care of them. Within that, stock choices, what weights and all that can differ from fund to fund.
Every style has its own, outperformance and underperformance. Now, what is that these investors have to remember? That, what are the cycles in which it can outperform? What are the cycles in which it can underperform? That understanding is very important.
I think that's very, very, very difficult to call out. Anyways, while they will have cycles, it's only a function of relative earnings growth and relative capital efficiency. Predominantly relative earnings growth, not even capital efficiency. For example, if you actually just look back in India, between say 13, 14 to 20, okay, relatively, these are all loose words, okay, loose phenomenon. Growth quality did well versus value. What people effectively are saying that relatively cheaper sectors, commodities, energy, PSU banks, metals, all these underperform to growth quality, which is relatively capital efficient businesses where the growth was higher, say private sector banks, insurance companies, consumer companies, retail, so on and so forth. Okay. Last, particularly 1.5-2 years, relatively value has outperformed quality growth in a broader sense. So private sector banks have underperformed, public sector banks, insurance companies have underperformed, consumer retail and staples would have underperformed the metals. I'm just taking random sectors. And why has it happened? It has not happened for any other reason, but the earnings differential between these sectors have narrowed. And in that context, contextually, some of the other spaces which had underperformed earlier had become more attractive. For example, why a PSU bank basket has outperformed a private sector bank basket? Because if you look at last 2-3 years, the earnings growth for the buckets is same, but the PSU banks were far more cheaper. Now there are a set of investors who are saying, okay, I want to play that from 0.7 times to 1 time price to book. Okay. And these businesses are already fairly priced at 2.5 times, 3 times price to book, some of them, or 2 times price to book. So this bucket has underperformed. So it's more relative cyclicality in the earnings that defines which part of the market does well. Okay. When relative earnings cyclicality on that side, it outperform. When relative cyclicality is on this side, it is outperforming. So it's just relative earnings cyclicality. It's not as if these businesses have suddenly become bad or these businesses have suddenly become relatively better than where they were. If you have to zero it down to one thing, how do you actually identify cycles, or why a particular, basically, say, growth quality versus value, for example, why a particular style was outperforming and why a particular style is outperforming today? I think it narrows down effectively to only single factor, that the earnings growth, which was 15-20% there and 0% here or 5% here, between say 13, 14, 15 to 20 or 21, has become like 13 to 15% for everybody, and probably this side it is little higher even.
Right. But since a retail investor cannot understand all of this, what they only know is, okay, fine, the fund is either outperforming or underperforming.
Correct.
So can they at least have a simple formula that maybe whenever the growth, because at the end of the day, it's all cycles. When growth outperformance, these funds will outperform, and when value outperformance, these funds may not give as much returns that other value funds are giving. Is that a simple formula that one can remember?
So it's only clear in hindsight. It's never so clear. Of course, you can get the trends.
Yeah.
Based on the house philosophies. So that's, for retail investors, probably that's the easiest one, that you broadly know that who's tilted towards which side. Of course, there are people who are purist on one side, there are people who are purist on extremely other side, we are somewhere in between, which is blend. So you always have to look at, and broadly people know which side the houses are.
So how do you want a retail investor to analyze your fund, both in terms of outperformance and also underperformance?
I think retail investors have to actually focus on both the things, that what kind of portfolio they are owning and what are the outcomes. Also, they have to focus on actually any strategy they buy into. First, unfortunately, because the Indian market is a retail market, there is less focus on the understanding what has gone behind the returns rather than the returns themselves. So every time people get into some fund, they should, from their advisors, should try to understand basically what kind of strategies these guys implement, what kind of style tilt these guys have, because that will give them comfort that they should stay put through the good cycles and bad cycles, because the outcomes are inconsistency. See, whether you buy a relatively growth quality portfolio, a blend portfolio, a GARP portfolio, or a basically value portfolio, it doesn't matter. You just stay put in terms of whatever allocation you are comfortable with through cycles, because that will give you the best outcome. Because otherwise, invariably, it will be clear in hindsight and you will move from one style to other after the outcomes have happened. So we are far more focused on risk-adjusted return than just outcomes. Because the returns can change overnight. Say, for example, today, the market is extremely bullish. Anything and everything is going up, okay? The most risky person on the street will feel that he's the best fund manager, okay? But these outcomes can change with one incident. Suppose tomorrow in Middle East, if there were to be war, is your portfolio resilient enough to take care of any form of instances that happen? And they do happen every 2 year, 3 year, 4 year, so that your risk in the portfolio is controlled, and your risk adjusted returns through cycle are good. See, all styles will go through cycle. You have to identify what is comfort, what is it that you can stick to, because your wealth creation over a period of time is a function of what you can in a disciplined manner stick to, whether it is value, whether it is growth, whether it is blend, doesn't matter. As long as you are bought into a strategy and you feel that these guys are consistent with that strategy, just stay put in a disciplined manner, keep allocating money, because that discipline itself is going to create more returns than actually jumping the styles or actually keep thinking more about the style. Like which we keep jokingly telling in a lot of our presentations, that most investors forget the first rule, that allocation is the first leg of discipline that the investors have to cross to make wealth. If your equity allocation itself is under allocated, then आप वैल्यू ले लो, ग्रोथ ले लो, कुछ भी ले लो, आपका ओवर अ पीरियड ऑफ टाइम आउटकम्स नहीं आने वाला है.
Now, if you see in the current scenario, there are a few funds from Canara Robeco which are slightly underperforming
Correct.
the benchmark. Is it because of the cycle?
It is predominantly to do with cycles, which is what part of market which is doing well and how it is represented in portfolio.
Yeah, this is what
like,
I want retail investors to know, whether it's like
what I said earlier also. There are a lot of weaker franchises, weaker banks, weaker tier 2, tier 3, tier 4, small caps, mid caps, which are doing equally or better than better businesses today. It is just contextual because of, like what I was saying, what I was about to say, the technical factor. There is a lot of non-institutional market participation today, and there is a lot of liquidity which is chasing the securities. So there is no differentiation in a lot of businesses that we find today. But we are very clear that the differentiation always happens in terms of businesses over a period of time, because most businesses fail to sustain the capital efficiency and earnings. So, and as that happens, that allocation impact that you see today in our portfolios on negative side will actually turn on the positive side.
Got it. Now moving to the next segment, which is about, we understood the style and what should investors expect. Now coming to the next segment, which is on, behavior, how important behavior plays a role in investing. How did you deal with, or how do you deal with outperformance or underperformance in the investing journey? Or how is it like
Dealing with
at Canara
outperformance is very easy.
Easy, of course. A lot of media calls and asking you to talk about it.
During the phases of underperformance, you just keep objectively thinking that whether the outcomes are because you have changed the way you function, the way you evaluate the businesses, the way you identify the businesses, the way you put them in the portfolio, or is it the market has changed? Which means if it is predominantly external environment, then you don't have to worry. But at the same time, you can't become complacent, so you have to keep rethinking that, okay, something is working in market and something is not working for you. Is it that something that is happening in market, you're missing out in terms of core thought process? See, there are a lot of things which will, say, for example, today's market context, okay, some of our portfolios are underperforming a little bit. In today's context, suppose there are a lot of things which might not be working for us. Does it mean all of those things you need to reflect on? You evaluate all the things, and then you said, okay, out of these 10 things, these are the 2 things which is our error of commission, which means we have not understood that these things need to be changed. So that's where we actually spend a lot of time on that. Okay, is there an opportunity which we have missed that you need to capture? But there will be a lot of factors. There will be a lot of factors which will be external environment, which you can't do anything about. Like, for example, there is a lot of retail participation today. Okay, there is a lot of PMS participations today. Okay, there are a lot of investors who are willing to take a risk which we are not willing to. I can't do anything about it. That's a choice that some other investor has made, and that is reflecting in the stock prices of certain businesses, certain small caps. Do I need to go there and start participating? No, that is not what you need to do. You just need to do, is it something that you are missing, which you need to learn and course correct in your style? Because the strategies are not fixed. It is like evolving, like what I said earlier also. Aviation, hospitals, hotels, these are the businesses I never owned in my entire portfolio journey from 2010 to 20. But after 20, we have owned all 3, and all 3 has created a lot of wealth. But as long as you can actually fix that riddle, that okay, why the stock is creating, or what the business is creating wealth, and what has changed on operating parameters, that's what you want to change, and that's where you want to change, not in everything else just because stock is moving up. So that's how we think about it.
Are there any philosophical lessons that you've learned during the investing journey, except that whatever goes up comes down, whatever goes down actually comes up?
I think that's true. Everything has a cycle, like I said in the businesses also. Everything has a cycle, so you have to be cognizant of those cycles. Uh, but it in a way it just gives you basically reflection points. Beyond that, you just take it in stride and you learn thing and you try to actually do things in a probably more efficient manner the next day. That's it. I mean.
Now, coming to my last segment, we talked about the style and then the behavioral aspects that come with it. When we were talking about the style, the continuity of the style that a fund house has is very, very important. Of course, because of two reasons. First, because any style works only if you hold it in the long term without moving from one cycle to another cycle or one style to another style. The second thing is also because there is a public money involved, people should also have some bit of clarity on what that kind of what a particular fund house style is, and when it works, when it doesn't work. Now, if you see in the past at Canara Robeco, there were times where there is a churn in the top management. Of course, I'm not talking about whether it has impacted the performance or not, or whether the style has been there or not, but there has been a concern that the top management has left a couple of times. Now, what is it that you are making sure now that the style continues? Of course, as an institution, it has its own SOP, but could you tell people who want to know about what is the fund house doing to retain that style in the long run?
So I don't think is this broader style and of blend is people dependent, whether people who are there or people who are left, because in predominantly the philosophy, thought process, or investment broader construct is defined in the investment process that you run. And that investment process is predominantly sacrosanct, and this revolves around all these parameters that you speak. So it's not not as if I'm telling you these parameters. It's part of the investment process as to how the businesses come in universe themselves first, and then they go into portfolios. So that is unlikely to change. Of course, every person adds its own layer, because you can't have fund managers which are same. Like as I said, within the same parameters also there are multiple layers, and different people operate at different layers or combination of layers in the same 3-4 parameters that I spoke about. Correct? Their weightages will be different, their tilts will be different within that. So that changes when a particular fund manager changes to other. But as I said, it's a combination of portfolio manager and investment process. That investment process has been very, very consistent, which in my view over a period of time, what my realization is that if you follow a consistent investment process through cycles, 60-70% of your outcomes are defined by investment process itself, which only means that the investment process is ensuring that there are no significant error of commissions that are happening. There is a consistency in terms of how the house ideates. There is a consistency in terms of what kind of businesses are coming in the investment universe. We have 350 companies under our universe. Every time there is a new business which is coming in investment universe, is that process followed or not? Because then that ensures that if it is not coming in universe, it will not go into the portfolio.
Yeah.
So even if, for example, tomorrow me as a portfolio manager want to buy XYZ, which is not part of universe, I can't buy it. It has to go through that entire investment process, which revolves around the factors that you spoke. And that's where that homogeneity or broader construct of the core philosophy remains as it is, whether people change or not. Of course, people changes have different impacts on execution, or different people have different styles within that in terms of execution. But beyond that, I think the investment process ensures that there is a continuity in terms of thought process.
Understand. So when you look for people to hire for the research team or for the, for the fund management team, what is it that you look for?
Yeah, we fundamentally, the one factor that we very, very carefully look at it is they have very good understanding of risk. Most of the people feel that portfolio managers or the asset managers are actually all about creating alpha. Okay, that's only half truth. It's a combination of portfolio manager is a risk manager, portfolio manager is basically a fund manager from alpha generation perspective. These are the two coins.
Never lose the money.
Never lose the money. So the first factor that we look at is that somebody we are hiring to manage money is not cowboyish, which means रिस्क को इसको पता ही नहीं है कि क्या रिस्क है. We are very, very careful about that personally because it's also innate to people. There are people who can take disproportionate risk without realizing that they are taking risk, okay, within the fund manager community. So that's one factor we look at very, very carefully. Second is, of course, then you look at how technically capable they are, how they think about their own career. A lot of times, of course, you can never control it, but you always think the professionals who think about their career long term, they're the people who will think about businesses long term, correct? So that is another thing that we keep looking at as every time there is a new hire, whether it is analyst, fund manager, junior analyst, do they think about themselves like a company in 3 year, 5 year down then where they want to be? That's another factor that we look at. Then of course there are other mundane factors or regular factors, whether technical skill sets, past experiences, everything.
Got it. That's all, especially when it comes to style. We have talked a lot of technical concepts here. I hope we will be making it as simple as possible. Lastly, maybe a rapid fire kind of a session where I'll just ask 5 questions both with respect to Canara Robeco and also your personal. Just quickly in one line or so. What do you do other than work?
I listen to music.
Okay. That's your stress buster?
Sorry?
That's your stress buster?
Clearly.
Okay. Got it. So if I have to ask, what is the motto of Canara Robeco Mutual Fund? The options are like create wealth for investors at decent returns, or generating second option, highest returns, third option, downside protection, or D, any option that you can take. What do you choose?
I think creating wealth on a risk adjusted basis is clearly, I'll add risk adjusted to it. Through cycles is the motto.
How does your personal portfolio look like, and between equity and debt, and between Canara Robeco funds and others?
It's all, I think, except the funds which I will be holding, which before joining Canara Robeco, everything else is in Canara Robeco.
Okay, mostly equity?
Mostly equity.
So equity. Okay. So for Canara Robeco funds, if you have to pick, make more money and have ugly years often. The second option is have downside protection and avoid such ugly years. Or any other option.
Sorry, I didn't get it.
2 options. Usually it happens in the investing side where you make more money and have ugly years often.
Okay.
And the second,
as a fund house.
As a fund house, yeah. The second option is protect the downside protection, have the downside protection, but avoid such ugly years also. Or any other?
No, I think it's not very clear. But let me add to the second. You avoid basically frequent ugly years. Try to do downside, and at the same time, actually try to ensure that through cycles you create above average wealth. That's the motto.
Good. Last question.
You don't want to have super duper year and then have very, very terrible years, because that's then investors eventually, unfortunately, like what we started at, most of the investors come after seeing 1 year, 3 year performance. And if I'm going to have frequent ugly years, most of the people will actually not make money. It will be on paper because somebody else has made money.
Right, absolutely. Now the last question, what is your way of giving back to the society?
As of now, can't think of there is any serious thing that I do apart from basic charity that you do through various means. Of course, I have certain plans. Let us see how they actually work out. After 3-4 years, I have some plans, but it is very, very, very premature at this stage. So
right. And they also say that when you are productive at whatever you're doing, that's the best
that's the best way to
contribute to the society.
If we can scale up this, I think as you speak, I mean, if I can actually create one more in a way objective, is that if we scale up this company to 5 lakh crore rupees, we'll give job to another 1,000 people. That's a way to give back to society.
Brilliantly put.
That's what we'll try to do probably. Now you've given me the objective.
Thank you, Shri. Thank you so much for
Thank you
joining
so
us.
much.
And
Thank you so much
for
for
making the investment process a bit more clearer to our viewers.
Thank you so much.
Thank you.